If you own a timeshare, you've probably faced a very, very expensive question. You bought it years ago, but now you're stuck, and the resale market is, well, it's brutal. You're probably wondering if there's any silver lining at all. Can you at least write off that massive loss on your taxes? Well, today, we're going to begin the forensic audit.
This slide, man, this tells a story that's just all too familiar to millions of people. On the left, you see what you paid. Let's just say $25,000. And on the right, what it's worth today on sites like eBay, a single dollar. And no, that isn't an exaggeration. For a lot of timeshare weeks, that is the market reality. And that, of course, leads us to the big one, the central question of this entire explainer. After losing all that money, can you at least get some of it back from the IRS by claiming a loss on your tax return? I mean, it feels like you should be able to, right? Okay, I'm just going to have to give you the bad news straight. The definitive answer from the Internal Revenue Service is almost always a resounding no. For the vast majority of owners, that tax deduction you're hoping for is a ghost. It just doesn't exist. So now, let's dive in and conduct that forensic audit to understand exactly why. The entire issue really boils down to one critical concept, the IRS Personal Use Rule. This is the bedrock principle that determines absolutely everything, and it explains why the thing you thought was a piece of real estate is treated no differently than your old living room furniture. And look, this is not my opinion. This is the law, stated plain as day right in IRS Publication 544. This is the primary piece of evidence. Losses from the sale of property held for personal use are not deductible, period. The keywords there, the ones that matter most, personal use. So here's the crucial point you have to get. The IRS doesn't care that your timeshare has a deed or that it's made of bricks and mortar. They only care about one thing. How did you use it? If you and your family used it for vacations, then for tax purposes, it's personal property. You weren't holding an investment, you were consuming vacations. The best way to think about it is like your family car. You might buy it for, say, $30,000 and then sell it 5 years later for $10,000. Do you get to deduct that $20,000 loss? Of course not. The IRS just says you consumed the value of the car. Well, your timeshare is viewed in exactly the same way. That huge financial loss is just considered the cost of vacationing. Now, I know what you're thinking. Some people believe they found a clever workaround. They try these strategies that so-called experts recommend online. But let me tell you, these are traps. They're based on mathematical fallacies, and frankly, they can seriously increase your risk of an audit. Let's break down the most common one. The most common flawed strategy you'll hear about is this conversion idea. The advice goes like this. Stop using the timeshare yourself, rent it out for a year to convert it into a business asset, and then sell it. The theory is that now you can claim that huge loss on Form 4797. It sounds pretty smart, but believe me, the IRS is way ahead of you on this one. And here's the firewall they built to stop this exact move. It's called the lesser of rule. When you convert personal property to rental use, your starting point for calculating a loss, your tax basis, is not what you paid for it. It's the lesser of your purchase price or its fair market value on the very day you converted it. This table shows you just how devastating that math is. You might perceive your loss as being almost $22,000, but if the fair market value of your timeshare on the day you started renting it was only, say, $500, the IRS forces you to use that number, so you sell it for $1. Your actual deductible tax loss isn't $21,000, it's only $499. All that effort for virtually nothing.
But wait, it actually gets worse. Let's say you do try to rent it out. If you're not careful, you can fall into a whole other snare. The hobby loss trap. If the IRS looks at what you're doing and sees no genuine profit motive, which is almost always the case with a single timeshare week, they can reclassify it from a business to a simple hobby. And the penalty for this is just catastrophic. Thanks to a key court case and recent tax law changes, if you're deemed a hobby, you have to report every single dollar of rental income you get, but you get to deduct almost nothing, not even your maintenance fees. The result? You end up paying income tax on your gross revenue, which turns a money-losing asset into a total tax nightmare.
Now, you might have heard of one court case out there that gives people a bit of false hope. It's really critical we address it so you're not misled. It's that rare exception people tend to cling to, the Murtaugh case. The scale of ownership here is the key, the massive difference. See, the Murtaughs, who did successfully deduct their loss, didn't own a single week. They owned 13 weeks. That's a full 25% of the entire condo unit.
They were basically running a commercial rental operation. In contrast, the typical owner has 1 week, which is less than a 2% interest. We're talking about fundamentally different situations.
So the crucial point is this. The court saw that the Murdaughs had a genuine profit motive. Their large inventory and professional approach showed they were in business to make money. The average owner, though, is just trying to get rid of a personal liability. The facts are just completely different, which makes this case a really dangerous precedent to rely on for yourself. Okay, so if you can't sell it for a profit and you can't deduct the loss, what in the world can you do? This brings us to the most important part of our explainer, the only safe and legitimate way out, and how you can do it without getting scammed. First, a very serious warning, and this comes directly from the Federal Trade Commission. Desperate owners are the #1 target of timeshare exit scams. These companies promise they can get you out of your contract for a huge upfront fee, but as the FTC notes, they often just take your money and deliver nothing. This is a predatory industry you absolutely must avoid. The real solution is so much simpler and cheaper. It's called a Deedback, or a voluntary surrender program. Almost all the major developers like Marriott and Wyndham have internal departments designed to simply take the property back from you. Honestly, they'd rather do that than deal with the cost and headache of foreclosing when people stop paying fees. So here is your action plan. It's a clear 5-step process. First, and most important, do not pay an exit company. I can't say it enough. Instead, call your resort developer directly. Use the specific terms deedback or voluntary surrender. That'll get you to the right department. Explain your situation calmly and make sure your fees are all paid up, because that's usually a requirement. This is the single most effective way to end your ownership. So, we've established that the massive financial loss from your timeshare is basically invisible to the IRS. And this leads to a final thought. Perhaps the real, unrecoverable cost of ownership isn't the purchase price at all, but the endless fees and the burden it places on you and your family, a cost that will never, ever show up on paper.